Hello everybody and welcome to the Algorithmic step-by-step guide to having your own functioning algorithmic trading system. Today we're looking at step number 3, or in this video we're gonna talk about planning your strategy. So at this point you've decided on the platform roughly. You could actually change that decision later down the road, but all you have is you opened an account. It's a test account at this point, and now you want to start using the platform. You have a strategy in mind, or you have something that you want to try, but not a solid plan. So today we're going to talk about what consideration you need to pay attention to when you're planning your strategy. So let's go right into it. So number 1, I have here the vehicle for your strategy. So that basically means what's your strategy gonna trade? So what are my options? So first of all, you have to look at what your broker supports. Some brokers don't support certain things. For example, if your strategy is to trade interest rates, some brokers don't have that. If your strategy is to trade stocks, for example, Ninja Trader, default brokers, which is like Philip Capital and there's another one, don't support that. They only support futures and forex. So you have to have an idea what's possible with your broker. If that is not working for you, this would be the time to actually switch to another broker. But hopefully you've done that research before, so you don't pick a broker that doesn't have the thing you wanted to trade to begin with. At this point, you've picked a broker, and let's say this broker is Interactive Brokers, and they have options. They have stocks, ETFs, they have futures, they have forex, they have a bunch of stuff. So that's what you want to consider here. So in futures, we do have types of futures. So we have commodity futures like gold, silver, oil, and there's also the equity futures, which is like the S&P 500, the NQ, the NQ mini and micro, and S&P mini and micro, and the Dow Jones, and other, I think there's other indices there as well. We also there's stock futures now, but I don't recommend that. And there's also forex type futures. They usually start with E, so there's E6, I think, or E7. One of them is a euro, and there's other forex type futures. We did say stocks and ETFs are basically the same thing. You have options, forex, and other things that you can consider. Factors that make for a good market. So not every market is a good market to day trade in or to have an algo going at it. These are my opinions again. So I prefer markets that have liquidity and they have narrow spreads. So the reason for that is that if your strategy is looking to exit, or you made a mistake and your strategy ended up going into a bad position, you can exit with a favorable outcome. If the spread is too thin, you can. If the commodity or the market you're in is liquid, that means there's always someone to buy or to sell to or from, and the spread is not that wide, so you're not going to take a big hit. So always pay attention to that. Volatility is also good. Crazy volatility is not good, because then your strategy is going to be a little wacky. You won't be able to get a good measure on how it performs if volatility is too wild. You want a market that moves, say forex market or the futures market, and within a day, depending obviously on what type of trade you're going to do, whether it's a swing or a day or a scalp or whatever. But you do want a market that moves. You don't want to pick a stock that, say, nobody's trading and it barely moves and it's too heavy, or it's not very liquid. So basically your algo is going to make one trade every month or something like that, unless that's the plan. So if that's the plan, then at least you've considered that. Familiarity. Pick something you're familiar with. Don't pick a market that you have no idea about. For example, people were trading oil futures and they didn't know that it can go in the negative, and that caused a huge problem. So basically, you find the oil future price at 5 cents and you're like, I'll just buy 500 contracts because you can afford it, but you didn't know that it can go into negative $30. So make sure you know what you're trading so you don't lose money just because of lack of information. Commissions. People tend to ignore commissions when they are considering a strategy, but commissions do make a big, huge difference. You may find yourself when you're coming up with your strategy that you need to optimize it because the way you wrote it, it's making $100 a day and you want it to make $1,000 a day. And so you multiply everything by 10 and then the commissions are not working for you because of the commission structure or something, or you end up paying more commissions that you think, and it will actually eat at your profits if you want to say take more trades during the day and you have a high loss ratio in your strategy. You can have a high loss ratio in your strategy that still makes money, but then you're making a bunch of trades that are ending up in the negative and you're being stopped out. Meanwhile, your commission is adding up too much during the day that your winning trades are not covering it. So commissions are important. You can do stocks now, so you could do that, or you can find that's also one of the considerations that you would think about when you're picking your broker, because brokers vary a lot when it comes to commissions, especially on the markets that are not primary markets. So the futures market is not a primary retail market. So you have Thinkorswim, which is Ameritrade, have high commissions for futures, but Interactive Brokers, for example, have lower commissions. You also have something like Ninja Trader, where if you are a lifetime member, you get lower than Interactive Brokers. Depending on the vehicle you're trading, the commissions will matter. Last thing here is availability. So I personally prefer a market that has more hours open than closed. And the reason is, again, if you find yourself into a bad position that your algo took that you want to close out of, you can. For example, the futures market is 23 hours a day. Yeah, it closes for an hour and 15 minutes in total. So I guess it's 22 hours and 45 minutes. Every day that market is open and functional. Forex, I think, is 24 hours. Meanwhile, you have stocks and options. Stocks actually do open. They have early and post-market hours. Options are very strict. They actually open right on time and they close right on time. So be aware of the time the market that you picked is operating in, so you can plan around it. Okay, next is algorithm types. You have to consider the algorithm type that you're gonna go with. I have two here, but there's more than that. There's arbitrage algorithms, these are algorithms that look at imbalances within the market. So for example, you can have an algorithm that looks at the micro S&P futures and the mini S&P futures. And if there's a price difference or an imbalance between this and that, your algo will take a position to bridge the difference. For example, let's say the price of the future is currently at 10,000, right? On the NQ, it's 10,000, and for a fraction of a second, the price of the micro NQ was 9,999. At the same time, your strategy notices that the micro is 1 point below the mini, and so it will take a long position in the micro and a short position in the NQ, and then you will you know that they're going to meet somewhere in the middle, or one of them is wrong and it's going to correct. So this way you can actually you have zero risk, because you're going to take 10 contracts on the micro and 1 contract on the mini, and they're bound to meet. Anyway, these are arbitrage type algorithms. So if you're familiar with that, that's one way to to go. Momentum algorithms, that's the most common ones. Basically, you're looking at the direction of the momentum, and you want to go with it, or you're trying to detect reversals and go against momentum to catch the reversal, whether it's going to the upside or the downside. So these are the most common ones. These are the ones that most people are trying to employ. Next, you want to look at your time frame. So you want to look at the time frame that your strategy is going to run in. So you're looking at the duration of the bars. Typically, you would run this in like some kind of candlestick or OHLC bars. And your algo is going to look at the indicators around this bar time frame. So if you're doing time, you're going to look at, you have 15 seconds, 30 seconds, 1 minute, 2 minutes, 3, 4, 5, 10, 15, 30, 1 hour, and so on till you have like 1 day or 1 week. So depending on the type of strategy you have in mind, you need to consider that. And that would decide what you want to do. Like, let's say you're gonna pick like 1 day bars. You can't do scalping on that. So if your strategy is scalping, it's taking very large volume or very large positions and exiting them within less than a minute. So if that's the case, you need to make sure you have something that has a large volatile or large liquid market, and the spread is very thin, so you can actually scalp, well. If you're doing day trading, basically your strategy is going to be closing everything at the end of the day. It's not going to keep anything overnight. So that's something to consider. And there are ways in NinjaTrader that will allow you to automatically close everything by the end of the day. There's also swing trades that your strategy could be doing, which is typically more than a day to about a month or so. So the fourth thing here, we have the bar or the chart type. And the chart type, there are charts that are time-based, which means basically every bar or every candle is a minute or 5 minutes or an hour and so on. And there are bars that are charts that are tick-based, which means every candle is 1,000 ticks or 2,000 ticks. That's also a way that you could build your strategy around. And there are also something called range bars, which is that your charting software will draw a bar every time the price spans a certain number of ticks. So let's say if you do 10 ticks on the S&P mini, for example, every 2.5 points, you'll see a bar being drawn and it's going to move on. So depending on your strategy, you're going to pick what type of time frame, and make sure also that your platform supports that. Not every platform supports everything, so be aware of that. Next thing, I have this item is realisticness. So I don't know if that's a word. I don't think it is. My number one thing here is that don't get bogged down with the technology. This is generally just having a mindset when you're creating or thinking about your strategy. Don't worry too much, or don't let the technology dictate what you can and cannot do, especially if you're not familiar with the technology. Like, let's say you are like an algo expert, then you know what can and cannot be done. But if you're not an algo expert, don't let the limit of your knowledge in the technology dictate how or how visionary or how imaginative or how the algo is gonna be. So don't worry too much if I want something that checks A, B, and C but not D, and you don't know, you're not a coder, you don't know how you're gonna write that, don't worry about that. That's something you can learn or find someone to do for you. But the important thing is it a good idea or not? And obviously be imaginative, but within reality. So don't go thinking, like if you're scalping, for example, you see a big spread on a certain stock, and you say, oh, I can scalp that, and I'll make the spread, and the spread is like 30 cents, and I will do that by shorting or going long 30,000 shares. Well, a market that has 30-point spread or a 30-tick spread is not going to be non-reactive to someone selling 30,000 shares. So yes, be imaginative, but be also aware of the fact that some things are not possible. You can't say go have a strategy that sells 1 million shares of Microsoft. As liquid as it is, it's going to move the market, and it's going to skew the results. So it might test well, because some things are not, like, keep in mind when you're testing something in a back testing, the market dynamics are not really applied in the back test as well as it is in real life. For example, I come up with a strategy that buys and sells 10 contracts, 10 S&P contracts. Now, if you look at during the day, the volume of the S&P minis is quite high. And then I say, okay, I'm going to scale this 100-fold. So I want to be a millionaire in 5 days. So you could do that, and maybe your software is going to actually let you back test it. It's going to fool you into thinking that you can sell 2,000 contracts without actually taking a hit on moving the market a tick or two against you, and you'll think this is great, but in practicality it's not going to work that way at all, because the fact is the backtesting systems cannot imitate reality to the tick. So they try as much as possible, but in reality things are slightly different, and we'll talk about that when we're actually implementing the strategy or when we are optimizing. Next, we have simplicity versus complexity, and there are two schools of thought about this. There's a school of thought that says the more indicators you are checking in your strategy, the better your strategy will perform. Now, there's some truth to that, but the school of simplicity says that a simple strategy is better, because if you can look at how the strategy is running while it's running and know why it took a certain position, and this is from personal experience, when I'm looking at my own strategy running and it takes a certain position, let's say it goes long, and I can tell why it went long, that's a good thing, because I understand that it's doing what it's supposed to do. But if it's some kind of black magic, that happens, that is great, but when you're starting out, it's not so great. If you're like, JP Morgan Chase, and you're running like 500 of those, people are watching him, and they have teams of people who build that and so on. But when you're building your own, a simple strategy is tried and true. And basically, if you can do it by your hand and you can turn it into an automated strategy and sit back and watch it, that would be ideal. For me, the reason I went into automating a strategy is because I have problems keeping my cool during a position, right? It's not 100% of the time, obviously, but if I could avoid it at all, that would be great. So if I tend to exit early, I tend to enter late, or not let my runners actually do run, these kind of things. People do day trade and make money, and do have good entries but bad exits, or do have bad entries and good exits. And so if we can fix that by automating it into a bot that can do it emotionless, that is the whole thing we're trying to do here. So in my school of thought, I think a simple strategy that you can actually do on your own, being automated, is the best. And so that's my take on this. All right, that's it for this part. Next, we're going to talk about how to code your strategy. So stay with us and like and subscribe and share. Thank you.